Hi guys, it's SJ speaking, and in today's video, we're going to see about one of the ratios. It is known as return on equity. In my financial ratio types video, I would have explained about different types of ratios. In that, there is one category known as profitability ratios, and it has two types. So, one is margin ratios, and another is return ratios. So, return on equity is one of the return ratios. So this is one of the fundamental analysis videos. People usually see it for long-term investing or for positional trading as usual when it comes to any fundamental analysis. So it is useful for these kind of investors and people. Before going into the video, I'm personally teaching trading. So if you want to join my mentorship course, I'm providing discounts for the first 25 members. If you're interested, you can contact me in the number which is in the scrolling below on my video. So let's go into the video. So what is return on equity? So return on equity, ROE is the short form of it. So it is one of the profitability ratios. It shows how well the company is efficient in generating profits for its shareholders by using the shareholders equity or shareholders money. It says we give money for the company and we get the shares. So with that money, how well the company is earning profits, whether it's earning enough profits. Only if it generates enough amounts of profit, it will reward the shareholders in the form of dividends, and also the shares capital appreciation would be high. So this is what ROE shows. So other names of ROE it is also known as return on net worth. So it is also called as RONW, or you can also call it as return on book value. So book value is nothing but if the company liquidates, if it gets bankrupt due to some bad financial situations, so it might sell all its assets. After selling all its assets, it will repay all its liabilities, debt. And after repaying, the remaining amount will be distributed to the shareholders. The remaining amount denotes the book value. This is the real worth of each share. So each share means its book value per share. So it is the real value of the total money. So it is what distributed to the shareholders. So this is known as book value. So ROE is sometimes also known as, you can call it as return on book value. ROE should always be high. So higher the ROE means the company is making good profits by using the shareholders money. The formula is net income, that is profit after tax, divided by shareholders equity into 100. Why? It's because ROE is always calculated in percentage. So into 100 must be in the formula. What is shareholders equity? So shareholders equity is nothing but it's if you didn't see my basics of share market video, see that I have explained in that video deeply about it. So shareholders equity involves equity share capital plus reserves and surplus, plus sometimes even preference share capital is included, but mostly return on equity doesn't include the preference share capital because it is calculated to the normal common shareholders. But sometimes the shareholders funds might include the preference share capital. So this is just the general formula which is used for the ROE. So it increases, high ROE increases the sustainable growth rate of the company. So if the company, if you're investing, if you're seeing the financial stability of the company, you have to see the sustainable growth rate of the company, whether it's growing at a sustainable rate, whether its growth rate is being sustained on a quarterly basis or on a yearly basis. So high ROE shows that the company's growth rate is sustaining. So this is what the high ROE tells. In simple words, how to remember what is the ROE? What is ROE? I can't understand. Then you can keep it as this. So ROE tells us how much the company, the profit makes with 1 rupee of equity. So for suppose if a company has an ROE of 25%, it generates 25 rupees for 100 rupees worth of shareholders money. So if your money which you are given to the company, suppose with that 100 rupees, with the 100 rupees of shareholders money, it's generating around 25 rupees. So this is what ROE of 25% means. Or you can say with 1 rupee of shareholders money, it's generating around 25 paise. So this is what ROE denotes. So this is simple way to easily understand the ROE, return on equity. Next, how to see, you can visit screener.in or markets mojo to see all the financial ratios and other fundamental metrics. So you can see those stuffs, and you can invest in stocks or you do positional trading, monthly trading. Generally you have to see whether the company has ROE of at least 15 to 25 percentage. So even more than 20 percentage, more than 20 percentage is even better. So you mustn't see the individual ROE. You must compare with you can see the individual ROE, but you have to compare with the historical ROEs and see if there is growth on a quarterly basis or on a yearly basis. So it shows that there is growth in generating profits using shareholders money, that the company has growth. So besides seeing the individual ROE, it must also be compared with competitors in the same industry to give a better picture of the company's profitability. This is similar to if you're analyzing any company and you're looking at any fundamental ratio, you have to compare with the other competitors in the same industry. For example, if you're trying to buy Tata Motors stock, you have to look at the other automobile companies such as TVS Motor or Bharat Forge or any other automobile stocks, and you have to see and pick which stock is better and invest in that stock. So ROE is highly reliable to measure the profitability of companies with low debt. The company may have different capital structures. It might have raised capital through debt financing as well as equity financing. So companies with low debt, with less debt financing, you can use ROE for that, for analyzing. It is highly reliable since it has low debt. Only equity financing is high. So you can use ROE for that debt, and it is highly reliable. So what are the limitations? So every fundamental ratio has its pros and cons, so advantages and disadvantages. So the disadvantage of ROE is that you can measure only the profitability. You can't say whether the stock is undervalued or overvalued. So it doesn't consider the market value. So yeah, so for seeing whether the stock is undervalued or overvalued, you have to look into other ratios such as price to earnings ratio, so earnings per share, so price to earnings growth ratio, that is PEG ratio. If you didn't watch my PE ratio or PEG ratio video, watch that. It would give you a better clarification. Or you can see other ratios such as price to sales ratio or price to book value ratio to see whether the stock is undervalued or overvalued. So ROE is only to measure the profitability of the company. So the general scenario is that if the net income, that is profit after tax of the company increases, the ROE increases. That is the general scenario. But sometimes even if the profit increases, the ROE might reduce. This is because of the fixed asset depreciation. Usually fixed assets depreciate in value over time. So this must be subtracted from the earnings. So it gives to a lower net income, which reduce the ROE. It doesn't mean that the company is not making profits, but because of the fixed asset depreciation, the ROE get reduced. So some investors might think that this stock is not good enough, and they might lose the opportunity. So this is one second limitation. And the third limitations is that there are several ways that the ROE can be artificially increased. For example, the what is the ROE's formula? That is net income divided by shareholders equity. So if you reduce the shareholders equity, if the shareholders equity is reduced, then the ROE is increased automatically. For example, there is 100 and denominator as 20. This is 5. So the company has ROE of 5. This is the natural thing. But if the company buybacks the shares, they own shares, they buy back from the secondary market. If the company buys back their own shares, then it leads to decrease of the outstanding shares. So equity shareholders value will decrease. For example, it's minus. So for example, it is decreasing around 10. So it comes ROE of 10. So ROE gets increased, but actually the profit is not increased. The profit is the same for the company. But since the shareholders equity gets reduced, the ROE is increased. It doesn't mean that the company is actually making profits. So this is one drawback. So some investors might invest thinking that the company is usually making high profits, but actually this is not the case. And the second thing, it can be the shareholders' equity can also be reduced by increasing the liabilities. If the company borrows more money, the shareholders' equity gets reduced. Shareholders' equity's formula is another formula is so equity share capital plus reserves and surplus plus preference share capital. This is what I have told you, but there is another formula. What is the formula of shareholders' equity? Is that assets minus liabilities. So for example, if so this 20 value has 50 assets and minus 30 is liability. So 20 comes, then the answer is 5. What if the liabilities are 40? Then the answer comes 100 by 10 is equal to 10. So if the liabilities are increased, so ROE can be increased artificially. It doesn't mean that the profit of the company is increasing. And the third is if the company makes continuous losses. For example, for around 4 quarters, that is one fiscal year, the company is continuously making losses. And the next beginning quarter of the next fiscal year, the company makes sudden profit. So there is a huge spike in the ROE. It doesn't mean that the company is generating significant profits. No, definitely not. So just because the company had prior quarterly basis, it had losses and a sudden profit, the ROE might increase. It doesn't mean that the company is making good profits. So investors might think that some investors might enter badly, so invest badly in some stocks. So these are the limitations of ROE. So that's the video, guys. So you would have get a better clarification of what ROE means. You can simply understand like this. If you are giving 100 rupees and the company, if the ROE is 25 percentage, with the 100 rupees of shareholders money, it's generating 25 rupees. With the 1 rupee, it's generating 25 paise. You can remember it as this. The formula is this: 100 percentage. Since it is in percentage, it is calculated into 100. So 15 percentage to 20 percentage is preferable. You can visit websites like screener.in, Markets Mojo, Investorlo, or Trendline and watch these stuffs. More than 20 percentage is even better. You can compare with historical ROEs and compare the growth, or you can compare with the other companies and select your stocks. So that's it. So hope you guys enjoyed this video. I will come in interesting videos like this. And if you like my video, so like it, give a thumbs up, share and subscribe to my channel, and also press the bell icon so you get notified for all my videos, and also comment if you really like the video. So if you want to join my trading mentorship course, you can call my number and you can have the details. I am providing discounts for the first 25 members. So join soon if you are interested. And then if you want to open a Demat account, I have given you Zerodha link in the video description. You can start your trading by opening the Demat account from today onwards. So hope you guys enjoyed this video. So thank you. I'll visit you on my next video. Until then, bye bye.